Good afternoon, everyone, and welcome to the James Cooper Creston webinar entitled A Difficult Destination. I'm Matt Purser, Director of Travel Trade Consultancy, and this afternoon we're going to talk through some business recovery and the insolvency process. There will be an opportunity to ask some questions, so please choose the chat function to pose these. We're going to save the questions until the end because I guess some of the questions may be answered through the presentations anyway. I won't be saying who the questions are from, so please feel open to ask those questions. They will be asked anonymously. And also this afternoon, we're going to be doing some polls with some questions for you to answer. So I guess that's a good place to start. So we're going to start with the first poll, if we may. Okay, so compared to 2020, were you expecting bookings you take in January 2021 to be up on 2020, the same as 2020, down 10%, down 25%, or more than 25% down? So we'll give you a few seconds to answer that, and then we shall reveal the answers. Okay, so no surprise that more than 25% down won, but yeah, bit of a surprise there that up on 2020 was so high, really. So I guess the travel industry has always been very optimistic and very upbeat, so that's good to hear. So we're gonna you're gonna hear from me later, but we're also going to hear from a couple of other people first. So we're going to pass over to Dan Fox first of all. Dan was Director of Harris Holidays, is now Director of Ski Elements, and he's going to share his journey with us. So over to you then, Dan, please.
Thanks, Matt, and good afternoon all. As Matt says, previously we were Harris Holidays Limited, and now Ski Elements, both traded as Ski Weekends as the primary brand. And the transition was achieved through a Prepack administration process, and I worked with Tom from James Cooper Creston to achieve that. Like many travel businesses in the past year, we found ourselves in an impossible situation, and today I want to share some of my experience of the Prepack process and explain our journey. My aim isn't to take you through the whole process step by step. It would take all afternoon, and I'm sure Tom will tell my son, Mr. Loader. Instead, I'm going to share with you some of the key points and what I learned. Thankfully, this is a process that most of us have very little experience of. That does also mean that inevitably it causes concern and anxiety when even considering the whole process for administration. I want to help you understand a little of what this option actually means. Slide, we're on it, okay? So what I'm going to run through today is, firstly, if you find yourself running out of options, Prepack administration may be a route forward for you. So why did I put Harris Holidays into administration? What's the process about? The timing and when to start the process? What Newco means to you? The strategy of going through this process with the end in mind, your directorial responsibilities, and some final thoughts, and I guess a summary of where we are today. So why did we put Harris Holidays into administration? The business was a ATOL ABTA bonded operator specialising in the ski sector, turning over £5 million a year, and I've owned and run it for 13 years. We had 15 UK staff and about 30 overseas on a seasonal basis. In January, it actually looked like we were having a good year. But by February, as COVID started to spread through Europe, the impact grew until, of course, in mid-March, where the full impact of COVID hit the travel industry and everything ground to a halt. The result for us was that we lost 25% of our season, leaving us with a refund liability of over £800,000 and very high irrecoverable costs. Through March and July, all the way through, we battled to try and get Sybil's loans, talked to various mergers and acquisitions advisors and investors, looked at selling the business to enable it to continue or to raise investors. Of course, the government came through with RCNs towards the back end of summer, but it was largely too late. Most customers had well and truly rejected them by that point. And it became clear over the months that by middle of July, we ran out of options and there was no reasonable expectation of a solution. Over the months, I'd spoken to 3 different insolvency practitioners, really to ensure that we were operating legally and to start to understand the process and the options that are available to us. However, in mid-July, with 350,000 in the bank, we actually engaged Tom as an insolvency practitioner and started the process of heading to administration. Why did we choose Prepack? Well, we believe and do believe in our business, which we've built up over many years. We have a strong, loyal customer base and also great relationships with many of our suppliers. And we wanted to find a way forwards, both for our customers and suppliers, and of course, to get some benefit from the many years of investment we put into the business ourselves. Fundamentally, it came to the fact that there really was no other way forwards. We couldn't get loans, we couldn't find funding, and we couldn't sell the business. Next slide, please. So what's the Prepack process about? You're looking for a way to enable a sound business to restart and continue. You've got to look at what the objective of an insolvency practitioner is. The insolvency practitioner's primary objective is to ensure that the creditors achieve the best outcome in the circumstances, i.e. to get them the most money, pence in the pound, that they can get out of this situation. It is not to specifically help you buy the business or you find a way to take the business forwards. The reason, however, that insolvency practitioners prefer prepacks rather than just liquidating a business is that the principle of a prepack is that a greater value is achieved for the assets of the company if they're sold immediately as a going concern rather than on a breakup basis, i.e. the business is worth more than the sum of its parts if it can continue in an uninterrupted manner to operate and trade. What I would say, having been through it and helped a few friends through it as well, is this is a difficult and stressful process. You have to accept at the point you engage the insolvency practitioner that you are closing the door on the business behind you and you're looking for ways to find the future. You must also understand that there is uncertainty and risk in this process. It may not go the way that you want. It may not be that you end up winning this process. So choosing an IP is really important. Start early, talk to several. This person is going to make a big difference to the future of your life. Believe it or not, Tom's association with us over a period of months will enable us hopefully to move forward positively. You need to get comfortable with that relationship and understand the differences in approach between different insolvency practitioners. They do take different approaches. However, they have a legal responsibility and will not compromise that. But you need to be able to work with them collaboratively in order to get the best result for the creditors and hopefully for you at the same time. I'd also strongly encourage you to make sure you've got a sounding board. There will be a lot to do, many decisions to make, and you'll need to get them right, both legally as a director and also for you for the right outcome. Having someone to check this with and challenge you is an important and reassuring part of this process. It's important to help separate your directorial responsibilities for Oldco and your aspirations for Newco. You absolutely have to wear 2 hats through this whole process. Next slide, please. Next, I'm going to run through timing, Newco, strategy and responsibilities. The timing is really important. Talking to several people, you discover a lot of people leave this very late. You want to make time to be able to make considered decisions, not to be stressed by the process as it runs away from you. Start planning before you run out of money. Start planning before you engage an insolvency practitioner. The more time you have, the better. Ideally, you're talking about months, not weeks. Remember that by looking at this, by talking to IPs, you are not committing to the process. And if at any point in time you find another solution, that's fantastic. And you will have helped yourself find the information that you need in order to find a route forward. But do start early. Some factors you'll need to consider: how much cash have you got at the bank? More critically, how long will that last you? Your income. Do you continue to take money from customers? There is a moral side to that and a legal side about continuing to take money if you are certain that you are heading to a point where you are insolvent. In fact, you may already be technically insolvent. What about creditors? Do you pay bills? You have to enable the business to continue trading and so look after the creditors appropriately. However, you must also be highly aware of not demonstrating a preferential bias towards certain creditors. If you prefer a creditor by paying them ahead of another one where perhaps you didn't need to, that can be legally challenged, and you might find Tom or your insolvency practitioner comes knocking on the door and actually asks you for the money back. Another important consideration is, could action by suppliers or customers force you into administration? Could they take legal action on you to force that process? At the moment, that's currently quite unlikely with the delays in the courts and various protections that are in place, but you still need to be mindful of it. What about the staff? You may know what 2P is. It's the process of passing staff from an old company into a new company as it's sold or goes through administration. You need to think carefully about the cost of redundancy and the timing of those if you're going to lose people and what that might mean in the future. Licensing. For many of us, the prospect of renewal of bonds is a major challenge and has been through the previous months, and I'm sure will be in the coming months, and I'm sure Matt will touch on this. But you need to be mindful that just getting to the point that you refuse to bond could stop your business flat. How much will it cost? Well, there is a real cost in engaging an insolvency practitioner. I'm sure Tom will talk about it. You need to be thinking anything up towards £50,000. That comes out of the monies that are still within the business. So looking at the other side, what about Newco? Well, before you start this process, you need to take some time to think about what your new company might look like. Decide what outcome you want. What does Newco look like? How big will it be? What's the objective turnover? What staff will you need? What will your role be? Also, you need to be prepared for what if you do not win the Prepack process. What does that mean to you? Where's that going to leave you? What happens if, as happens with us on many occasions, what if someone interesting makes a bid during that process? Would you work with someone else if they had control of the business? Indeed, would you work for someone else when it's no longer your business? It's good to think about it early. It's a real possibility that will happen in the process, and you won't have that long to make a decision once you've engaged the IP before you enter administration, a matter of a few weeks. If you're successful, will you have the funding to take the business forward? What are you going to do about bonding? What about your technology, your reservation system, your accounts package, your website? What team do you need? What about new bank accounts? These are difficult to set up these days, as are merchant services. And don't forget, you will still have directorial responsibilities for the old company. They do not stop at the point you appoint an insolvency practitioner. So you need to ensure that before you go through administration, you are not distracted or slowed down by the drains from the old company. CA and bonding issues can take a great deal of time, which is why having a strategy at the start is really important. And finally, you need to decide what you can afford and what you are willing to pay to buy your business back, because that's actually what you will be doing. Strategy. It's important to start with the end in mind, hence thinking about Newco before you even begin. This is a process, and working with the IP, you will achieve the best possible outcome. You need to work alongside them hand in hand. I talk to Tom almost every single day for about 2 months. It's an important thing to be in touch and know what's happening. There are a lot of steps, and your IP will help you and guide you through it. But it is your business, and you will have your own goals and responsibilities. And you again have to remember you're wearing two hats. You're looking after the creditors from the old company and also considering what the new company might be. Before you start, have all the facts and information prepared. This will help you, but it will also help the IP, and you'll have a smooth process. That's not just important for your relationship with your insolvency practitioner. You don't want delays. Things you'll need to consider are your cash flow, going back to what I said before, as you enter administration and for Newco. 2P, what are the costs on either side? What I mean by that is, what does it cost currently to make the staff redundant now? And if you 2P them through and need to make them redundant in the future, what will the costs be? You'll need to prepare an information memorandum. You are actually selling your business. So to achieve the best results, you need a good IM. You need to understand clearly what is going to engage interested parties and make them want to buy your business, and what will disengage them and make them not want to buy it, depending upon who you're talking to. Up-to-date management accounts are essential, and full details of all creditors will be required immediately by your insolvency practitioner. Maintaining key supplier relationships is important, so do have open communications with them as early as you feel able. The CA and ABTA and any other bonding organisations require a huge amount of information. It's far more complex and time-consuming than you might expect. And it's well worth getting ahead of the game and using the resources of the old company to draw that information together rather than it being a burden on the other side. It's not just issuing ATOL certificates and ensuring refund credit notes are in place. If you want a successful Prepack, speed protects the business. The faster it goes through, the less issue there are with creditors, with suppliers, the less opportunity there is for them to distract you from the process. That will also give the best result for the creditors, meaning they get more money now, and potentially they benefit from future relationships with you as well. A slow process may also cause irrecoverable damage to your brand and of course can hit social media once there's any awareness at all. You may also be focused on retaining the goodwill of the staff who you may want to carry forwards, or even those who you're making redundant. Many of us actually value and have long-term relationships with people we very sadly have to let go. A little on your director's responsibilities. You are responsible to ensure the creditors get the best outcome. I've said that about 3 times. It's so important that you keep that as a clear focus at the same time as obviously trying to find the outcome for you. You remain responsible to assist the insolvency practitioner, the CA, ABTA, and other parties after administration and technically until the business is liquidated by the insolvency practitioner. If you have personal guarantees, please remember these stand. Any loans will still be called upon you. Do check your bonding agreements. Many of them do contain requirements on personal guarantees, and they will not go away. If Newco is using the same directors and shareholders, you are technically in use of a prohibited name. It's another step you need to go through to ensure legality of the new company. It's not particularly onerous, but it is important. And you need to be clear in your own mind where the difference falls between your old business and your new business. I know I keep repeating that, but it's quite difficult through an emotional and complex process to keep wearing those 2 hats. And next slide, please. We're almost at the end. Finally, this is the last option. You don't enter into administration and Prepack if you think you've got another way out. What I would say is don't run out of time before you're forced to stop trading. Enter into the conversations early. Is Prepack for you? Do you have the energy and resource to start again? Because with reduced teams, reduced staffing, it really is back to basics, building everything from scratch. It's actually incredibly hard work, and you end up doing jobs which you haven't done for maybe 10 or 20 years. Timing is really important when considering a Prepack, not just the timing of your process. But if you think you might not start again for several months, you have to decide if this is the best option for you, Or actually, would it be better just to buy the brand and start again sometime in the future? It's important Prepack is not risk-free. You could lose the business, and you shouldn't be there if there is an alternative. What I mean by that, sorry, is you can lose your business and you shouldn't be at this particular step in the process if you've still got alternatives on the table. Keep an open mind. You may be surprised that there may be a buyer that comes along that wants to work with you and incentivize you into the future. Be clear about what Newco looks like and what you want to achieve. Decide what you're willing to pay and how you're going to fund Newco, and be ready. I suppose absolutely finally, a little outcome from our side. It hasn't really gone as we anticipated. We completed our Prepack on the 4th of August, about the same time as our government decided that quarantines were a good idea. Unfortunately, that did mean that the staff we took 7 staff through with 2P. We ended up making 5 of them redundant over the coming weeks, which we've had to pay for to deal with properly. And it hasn't been easy. However, we have restarted our business and we have protected the brand. We've maintained our relationship with the majority of our customers and re-engaged and rebuilt relationships with the majority of our suppliers. I've mentioned 2P. We still have great relationships with all of the staff who we 2P'd through, even though we subsequently let go, because they know we've done the absolute most to look after them. We're working every day and it's working hard to try and find the best solution in what remains an awful situation. It's a long way to go, but we are optimistic and we remain pleased that we prepacked, and also, to be honest, pleased that we worked with Tom to achieve that. That's my part over, thank you. Very happy to answer any questions at the end, or indeed, if any of you want to contact me privately at a later date, I'm available to talk. Thanks very much. Matt, over to you.
Thanks, Dan. And yeah, really interesting to hear from that side of things. And I think it's a good point you made around the personal guarantees in particular to keep an eye on that. We have had some questions come through, but so we're going to save them to the end. So what we're going to do now is move on to the second poll question, if we can. Okay, so based on bookings you have now taken so far in January 2021, are you expecting these new projections that you made for January 21 to be better than forecast, the same as forecast, or down on your forecast? If you can answer that, and we'll have the answers in a few seconds. Okay, so most people are down on forecast. I guess none of us really saw the third lockdown happening on early January, which has had a huge effect on that. So I guess yes, there was no real surprises there, unfortunately, from that side of things. So okay, well, we've heard from obviously from the tour operators side of things, and we're going to pass over now to Tom Russell, who's going to tell us from the administrator's point of view. So over to you, Tom.
Thank you, Matt, Dan. Good afternoon, everybody. My name is Tom Russell. I'm a director at James Cooper Creston. I'm a qualified accountant. I'm a licensed insolvency practitioner. I've worked with many businesses in the travel sector, both pre and post COVID, in both advisory role and in a formal capacity as an administrator or liquidator. And I want to speak to you today about the insolvency from the perspective of an insolvency practitioner, what we think about what we're obliged to do, focusing on some of the particular challenges presented by COVID, and also some areas specific to the travel industry. I won't go into detail about the COVID pandemic or the impact of the measures, because I'm sure everyone's overly familiar with the problems faced by business and society in general. And Dan's already described some of the difficulties which caused his business, which I think are common to nearly all the businesses in the travel sector. But I think it's fair to say the travel sector has been one of the hardest hit as a result of the pandemic with the travel restrictions. Needless to say, the situation is extraordinary and unprecedented, which has led to businesses and individuals who would never previously have imagined being under serious financial pressure. having to deal with the huge uncertainty as to the future and make extremely difficult decisions which affect their staff, their customers, their suppliers, and them personally. Just going back 10 months to the start of the pandemic, our general advice at the time was to sit tight and see what unfolded. The introduction of the furlough scheme and the other measures through the spring, such as bounce back loans and C-bills and tax deferrals, offered many businesses a lifeline and have saved a large number of jobs, although it remains to be seen how far that will go when the support is withdrawn. And whilst the rollout of the vaccine in the UK gives a glimmer of return to normality, we can see from the poll that there is still huge uncertainty. And whilst the media reports on one hand that the rollout is accelerating, it appears that the government are managing expectations with regards to how long it might take for for a large proportion of the population to be vaccinated and allowing the lockdowns to be lifted. And of course, for the travel sector, the vaccine rollout in many other countries is slower, and it remains to be seen when vaccinated UK holidaymakers will be allowed to travel and whether they will want to travel to areas where restrictions are in place or might be in place in the future, giving uncertainty in terms of booking holidays. Whilst anecdotally there is a good deal of pent-up demand, and some travellers took advantage of the easing of lockdown restrictions last summer to travel, I believe the return to normality will occur over a period of time, will be quite region and country specific. Looking at businesses for a moment, it's been a year since the pandemic, and it remains to be seen what extent the government support remains when we are on the way out of the pandemic. I think there's a danger for some sectors that they get forgotten as things start to return to normal. But the true financial impact on a business of the pandemic may not be apparent for some time. The government measures do not replace lost revenue, and importantly for the travel industry, do not deal with refunds or credit notes. And the balance sheets of many businesses will therefore have been severely negatively impacted. Businesses are likely to be more heavily indebted. They have loan notes, HMRC deferrals, bank loans, C-bills, bounce back loans on their balance sheet, which is all against a backdrop of little or no revenue for the last year. Turning to strategy, Dan went through briefly the options he considered, and I think the options for the travel sector are broadly the same as for other sectors. You would try to restructure to reduce costs, to take advantage of government schemes, to adapt your products potentially. You would look to investment, either by way of loan or equity investment. You may look to merge or acquire. When these options have been exhausted or don't appear reasonable, I think you're left with insolvency options, such as informal insolvency procedures, maybe a liquidation or an administration. One important factor to ascertain at the start, I think, is when and if your company is insolvent. There are two legally defined, two important definitions for insolvency. One, the balance sheet test, where a company's liabilities are greater than its assets. And there's a cash flow test where a company cannot afford to pay its creditors when they fall due. Of course, the latter is somewhat skewed by the fact that staff are being furloughed at the moment, and so employee liabilities may well be paid for by the government to a large extent. Now, whilst it's not an offence to trade while insolvent, directors have responsibilities, and I'm going to speak about them in a bit more detail later on. As Dan said, these procedures are in effect the last resort, and whilst they will almost certainly involve creditors to some extent going unpaid, they're not a tool to avoid paying debt. At the time of entering into a procedure, the company is already, almost by definition, able to pay its debts. And the procedures seek to appoint an independent person who is regulated to manage the process of the company winding up, to realise as much value as possible from the assets, and then to distribute the proceeds equitably in accordance with statute. I'm not going to cover all the various procedures in any detail. I would mention that in the summer of last year, the government introduced a new a monitor role, which requires an insolvency practitioner to act. This was brought in the Corporate Government Insolvency and Governance Act, and it gives directors the opportunity to apply to court for a moratorium period where creditors cannot take action. This is a relatively short period of initially 20 days where the company is given breathing room from any action to allow a recovery process to take place. This hasn't proved to be a particularly popular process as yet, maybe because 20 days isn't really enough time, but I can see in certain scenarios, for example, when you have an investment which is imminent but the company is under creditor pressure, where a short moratorium period without having to go into a formal insolvency administration, for example, would be useful. If we can move on the slide, please, Lizzie. I just want to talk a little bit more about directors' responsibilities. Dan touched on this, and I'm not going to go into them in detail, but directors have fiduciary duties, and I really want to look at the conflicts a director might face. As you can imagine, the director's fiduciary duties are basically to act in the best interest of the company and not necessarily their own best interest, but a director may also be an employee of the company, a shareholder, a creditor, either directly or via a personal guarantee, and potentially could be a potential purchaser. And these are very difficult conflicts to manage. And I think they are managed, as Dan said, by taking advice not only from the insolvency practitioner, but the directors potentially taking personal advice about what they do in certain of those roles. Now, the director's objective typically in a normal situation is to create shareholder wealth. However, when a company is insolvent on the tests I mentioned above, this objective typically shifts to protecting creditor interests, as Dan said. Now, an insolvency practitioner, when appointed, has a duty to investigate the conduct of directors and report to the insolvency service on that conduct, who can then take action to disqualify. They've also got a duty to identify claims that can be brought against directors if there's been any wrongdoing. As I said, I'm not going to go into detail, but I think one of particular interest is wrongful trading. Now, this is interesting for two reasons. Firstly, because it goes to the heart of the question of when should the business stop trading, and secondly, because it was and remains suspended by the government as part of their response to COVID. So wrongful trading actions can be brought when a director has traded a company when they knew or ought to have known it could not avoid insolvent liquidation. So the government suspended this provision, and it did so, I think, in acknowledging that directors in March, April last year had an almost impossible task in making a reasonably informed decision given the uncertainty they faced. And they did not want the potential of an insolvency practitioner bringing a personal claim against the directors to influence that decision of the directors, because erring on the side of caution, a director may think, well, if I'm at personally risk for this, why would I carry on? And that almost trigger the negative impacts for all stakeholders, creditors and lenders and the company employees. And they didn't want a rush of insolvencies caused by directors being cautious and potentially being reasonable. So the suspension doesn't remove the difficult decision of when to stop, but it does remove, for the moment, until April at least, the potential personal impact on a director in continuing to trade. That said, if a director acts unreasonably, there are other actions that can be brought against them if their action is not up to scratch. But it's looking back at the decision of when to stop. It's not something that happens overnight, and directors have to make a judgment. And typically, creditors are better off if there is a managed wind down, even if it's only for a few days, rather than just switching off the lights and sending everyone home because there's no other option. So thinking about options early, as Dan said, and planning can provide creditors a better outcome. In the time when the directors may have decided to cease to trade but not have yet done so, or yet appointed an insolvency practitioner, they will often work with advisors, as Dan said, and also give notices to secured creditors or the Financial Conduct Authority if it's a regulated business, or the CAA ATOL, for example. And at this time, directors should act to preserve assets and reduce as far as possible any additional credit being incurred. As a result of the change in the law, as I said, the IP cannot bring an action for wrongful trading, but they can bring other actions such as misfeasance or preferential transactions or transactions of under value. I think the key thing for a director or board is to document the reasons behind any decisions, so that if they're ever reviewed, it's clear what information was to hand at the time, so their actions are not viewed with the benefit of hindsight. I think that's even more pertinent advice now, given the uncertainty. What might look like a reasonable decision in March may look almost reckless 3 or 4 months later as the pandemic unfolds. Just moving forward to the next slide, I just wanted to have a brief look at what the role of insolvency practitioner is after they have been appointed. This is simplified, but our duty principally is to collect assets. It's to undertake various statutory duties and regulatory functions, to oversee the orderly winding down. It is to pay a dividend to creditors if that's possible. Looking at the first, realising assets, a company will have a variety of assets, from tangible assets such as property or vehicles or plant, to intangible assets such as intellectual property or trademarks, for example. The insolvency practice as well as to sell these and make a net contribution to the estate. In the travel sector, along with other businesses that operate online or in the area of technology, for example, they will have relatively few tangible assets, with a significant proportion of value being in their intangible assets, such as their website or brand. Often they will have talented employees, which are the core of the business. They will have relationships with customers and suppliers. Now, tangible assets, as Dan has said, remain more valuable if they are sold as a going concern, which also means liability for employees is transferred, and they're not damaged by an insolvency process. For example, an administrator on appointment would have to take down a company's website or put a notice that it's in administration, which would be detrimental to the value. They'd also be likely to make staff redundant, and then realising value after that for those intangible assets would be difficult, and if not impossible. To mitigate some of this loss, therefore, the pre-pack process is utilised where a buyer is found for the business prior to the appointment, and then the sale of the assets goes ahead immediately on the appointment. I'll discuss that in a little bit more detail in a moment. The office holder has other duties, such as to notify creditors, deal with employee claims, undertake their investigation and report to creditors, and pay a dividend if possible. They're paid in the order set out in statute. Typically, the secured creditors get paid under their fixed charge. The preferential creditors get paid next. That is up until the 1st of December last year would be employees for certain claims. As of the 1st of December, HMRC are now a preferential creditor in relation to VAT, employees' national insurance contributions, and some other claims. And then the secured creditor gets paid under their floating charge, and unsecured creditors, if there was any money left, would receive a dividend. Moving on to the last slide, just looking at Prepacks in a little bit more detail. They have been criticised for not being transparent or for facilitating existing management to dump debt and carry on. It is possible, as in the case of Dan's business, that company assets are sold to existing management or other connected parties, but this does not happen in most cases, statistically. Ultimately, it is the party who offers the most value for the assets that will be the successful bidder, and it is the administrator who takes responsibility for undertaking the sale. Ultimately, the administrator must be satisfied that the transaction offers the best outcome for creditors in the circumstances, and they are held accountable by their regulators and potentially creditors if they don't. As a response to the criticism and to provide a framework, SIP 16, Statement of Insolvency Practice 16, was introduced. This guidance sets out how administrators should undertake the pre-pack transaction, and it puts a burden on administrators to justify the transaction to creditors as soon as possible. And it aims to make clear the benefits of a pre-pack whilst informing creditors of that it took place as soon as possible, within a day or two, of that the transaction took place and the basis of the transaction. The SIP 16 details various factors an IP would look at and would need to comply with when undertaking the sale. I'll cover those in a little bit more detail, But in order to ascertain whether the transaction offers the best outcome, the option of the pre-pack is assessed against the next best option, which is generally a liquidation. Now, liquidation is generally unlikely to achieve a substantial realisation for intangible assets, and the outcome for creditors in a pre-pack is compared against that, as I say. Just to reiterate what Dan said, a pre-pack is not necessarily a good option for creditors. It is probably the least worst option in the circumstances. Any offer from directors or connected parties is judged the same as all other offers. And when undertaking a pre-pack sale, the IP has a duty to market the business as widely as possible in the circumstances. The administrator must justify the level of marketing they undertook. Sometimes agents are used to find buyers. Often the opportunity is advertised on bespoke distressed business sale portals on the internet. The IP should not replace reliance on work already undertaken by the management. But clearly management may be best placed to provide details of potential purchasers. And coming back to the conflict point, the directors of the business are obliged to provide information to the administrator or the proposed administrator to allow this to happen. Whilst the marketing might be for a short time, the timing has to be balanced against the difficulties in maintaining a business for the period where it's being marketed, given the restrictions placed on directors' duties, the potential lack of cash, and the ongoing damage to the business in it, and the trade carrying on under those circumstances. The administrator should by default obtain valuations of assets or explain why they don't, and they would use these to compare potential offers. It's standard practice to obtain valuation of tangible assets. Obtaining valuation for intangible assets, such as goodwill, can be more difficult and is often best tested by looking to the market. An IP should also try and consult with the majority or the largest creditors about the process before it takes place. So, for example, the primary lender, or in the case of travel businesses, the CAA or ATOL. Other considerations when considering whether a pre-pack offers the best outcome is the impact of TUPE. If it's a going concern sale, TUPE will almost certainly apply, which means the liability to staff will pass to the new business, which means that those employees do not claim against the old business, which can enhance the dividend made to the other creditors in the company going to administration. It will also allow employees employment to be preserved, which is obviously beneficial generally. So if an insolvency practitioner is faced with a decision to sell to existing management, which would achieve a dividend to creditors and continuity of employment, or decline a sale to existing management, which results in a reduced return to creditors, the insolvency practitioner will choose the best outcome for creditors and sell to former management. That does not mean that there won't be a sale to a third party, or in the past we have spent time marketing business and not received any interest, which would result in the pre-pack process being abandoned and the company typically moving to another process such as liquidation. I will leave there and hand back to Matt, but I'm happy to take questions, as are the others at the end.
Lovely, thanks for that, Tom. The questions are racking up, but as you say, we're going to save them to the end. So we're going to do our third and final poll before I'm going to add a few words. So once the world returns to normal, do you ultimately expect your business model to eventually return to 2019 levels, or do you think your business model will now change forever? Okay, so the majority of people think their business model will change forever. I think 2019 levels were certainly obviously a high point, and I think 2020, before all this hit, was expected to be even better. But certainly some of the companies we've been speaking to it's given them a chance to really look at their business model and how public will will change the way that they buy holidays in the future. So thanks everyone for participating in those polls. I'm going to run through some bits now. So I'm going to look at sort of some bits that Dan and Tom touched upon, but maybe in a bit more detail really from the other side of things. So if we can move forward onto the next slide for me, please. So I think there's a sort of number of areas I just wanted to raise really, and for people to be aware of when they're looking at their new business really. So the first one is around the regulators. So we've seen how regulators act in the past when there's been failures, and directors and shareholders have been involved in previous failures, and they come back into the travel industry. What they'll look around is the report done on the liquidators report around whether the directors acted in the right way, or was there any reason why those directors should actually be disqualified now going forward. I guess COVID has thrown up a number of questions, because what we don't know really is how those regulators are going to react to new businesses coming through. So will they put it down to the fact that all these businesses were affected by COVID, and therefore no further action should be taken by the regulators, or will they look to impose some stricter requirements on them, or sort of not give them the license in the first place. So that was one area I just wanted to cover and be aware of. The next one really is around credit card merchants. So I guess we've seen the appetite of these merchants diminish over this period. It's certainly shrunk off the back of COVID, and them being worried around what their exposure is, and potentially more travel companies ceasing to trade. I think that's likely to be made even more difficult to get those facilities if you do have a failed company behind you. So that's another area to be aware of. And insurance is the next one, which again I think is something else that you need to be aware of as well, because the insurers, again, the appetite has changed over this period. How will they react to the fact that they may have had liabilities under the policy before, or under their policy, or a different policy? So all of these areas are to be looked at. I mean, it may well be that your next business is not going to be a regulated business, and so some of these fall away, but certainly things to consider. The next two really were areas that Dan touched upon slightly, and we might go into a bit more under the questions really. The first one was around suppliers. Suppliers may well have lost money during the fact that you'd gone into administration. Are those suppliers ones that you need to use going forward? How will they react to you trading with them in the future? So that's something to be aware of. As are the customers, your consumers. You've bought the brand back. That brand has a value, and ideally you're looking probably to re-engage with some of those customers again. Again, it's how you manage that process going forward as well. But on the next slide, I really wanted to share with you as well was around this is sort of some of the changes that we've seen over the years around ATOL. And I'm not going to go through each point, but really this is to demonstrate the fact that the regulators are reactive. They're not proactive on these. So when you look at different scenarios that have happened, so if you look at 2008, for example, the APC charge was introduced. We then had, in 2008, 2009, we had the failure of XL Leisure Group, which then led to the increase in the APC from £1 up to £2.50. We've seen various changes happen over the period. We've seen EasyJet come about after the first package travel regulations were introduced, and you can see it took a long time for them to finally catch up, but that's what 2018 changes to the regulations were around them finally catching up. So I think it's inevitable that we are going to see some changes to the regulations going forward off the back of what happened in COVID. The regulations were never written to deal with a pandemic, and they have to catch up Whether that will be this year, next year, or in 10 years' time, I guess we'll have to keep an eye on that. And I guess my last slide, really, I only wanted to cover off quickly, was the 3 areas that I think will come into the review, really. The first one is around trust accounts. We've heard lots and lots of people within the travel industry talk more around trust accounts. We've seen credit card providers trying to push people down the route more of trust accounts. I think as we sit here today, they are not the perfect model. You know, a lot of the trust accounts were allowing money to be released to prepay suppliers. So when customers were looking to get refunds, the monies were back in that trust account to be able to get that refund. So they're certainly not the perfect model. But I think the regulators, credit card providers, customers even may push people down the route of using trust accounts more. So I think that's something we are going to have to live with. The one in the middle is the regulations, as I touched upon. So they weren't written to deal with pandemics. It talked around refunds being due within 14 days of cancellation. That certainly wasn't built on the fact that the whole world was going to close down. So those regulations will be looked at. I'm sure there will be consultations coming out this year around about that. And the third one on there is around about airlines. How are airlines finally going to be brought into consumer protection? Yeah, up to now, they didn't have to provide any financial protection around that. Is that pressure going to build upon airlines? We've seen bailouts from government. Is that pressure going to be great enough now that actually has to bring them into the fold as well? So I think the future is going to change off the back of this, and there are 3 areas really that I think we need to look at. So that's all I wanted to cover off for now. So what we're going to do now is to move over to some of the questions, if that's okay. So I'm just going to go through these in order, because there are quite a few, and it's going to help me keep a run of which ones I've asked or not. So I may jump around a bit, so apologies for that. But the first one is to you, Dan. In terms of, you mentioned you engaged with Civil Aviation Authority and ABTA. How far into the process did you engage with them? And the second part to that is, were they very helpful?
So pretty much at the same time, within a day or 2 of engaging Tom, I contacted the CAA and ABTA and Towergate, who are underwriters. The first reaction was one of surprise that as a tour operator had actually contacted them to tell them it was going to happen, which was quite interesting. On a personal level, they were community friendly, helpful, and tried to be supportive. I didn't get a sense of being, to put it bluntly, told off. But what I would say is it actually weren't incredibly helpful. There is a huge amount of information that they require, and it took days to get that information from them in the formats that they specifically require it. And when you go back with questions, it was taking 2 or 3 days to get back with format answers. So trying to give them information they actually needed was bloody hard work. And it's like trying to deal with any regulatory body. Although, to be honest, I was and am still somewhat disappointed at the communication with them. It just in their timeliness and clarity in communication. The biggest thing is that as a member of both for years, we had no real understanding of the information, the detailed information that they would require in the event of a business failure. And some of that information, you could question whether it's pushing GDPR, frankly. It's really interesting, but without going further, yes, talk to them as soon as possible, but don't expect great communication. What I would strongly say is if you choose an IP that's been through it, like Tom, or you talk to somebody like me that's been through it, we can provide you with the information that you're going to need to prepare in advance. And having that time and to do that, it's worth a great deal in terms of saving you time and effort.
And in terms of timing, then you only spoke to them once you'd engaged Tom. You didn't involve them in any conversations before that around this is what you were thinking.
Well, I spoke to them initially, because remember, when you engage, Tom, you haven't appointed an administrator. You are not actually in the act of administration, so to speak. And at any point in time, you can step away from that engagement. You need a good reason legally, because you've already said, basically, I'm now insolvent. But at that point, you can engage in a conversation with the CAA. I have heard of examples where large organizations have negotiated CVAs, country voluntary arrangements with the CAA, but they were certainly not open to that conversation at all with us. I'm not sure they're particularly inclined to go down that route.
Okay, thanks for that, Dan. I'm going to come to you again, Dan, but maybe Tom, you can add to this after Dan has given his initial answer. But someone's asked the question around potential conflict of interest when you're drawing up the IM. Obviously, I guess there's a minimum amount of information you need to include in the IM, but the question raised is presumably you don't want to do such a great job that it raises interest from lots of prospective buyers and you've suddenly got more competition in there. So how did you manage that process?
I think to start with, if you've ever entered into an M&A process at all and tried to sell your business or gain investment, there's quite a difference between selling your business and marketing your business. What I mean by that is, if you're trying to sell it to a third party, you're going to shout from the towers everything you can think of that's possibly good and all the hope and aspirations you have for a business. The IM that Tom or an IP will guide you through, because they have an obligation to ensure it is accurate and provides the right information, is somewhat more flat, shall we say. And it is important that you give clear, honest and accurate information. I would possibly suggest that the IM that you produce in this case is perhaps more factual and honest than it might be if you're actually selling your business. There may be areas you gloss over when you're selling. And the final point I'd make on that really is the other comment that I made, that you're right, it's a balance here. If you're selling your business, you don't always point out all the shortfalls and things that in our industry particularly can cause concern for investors. A great example is accommodation commitments, where you know, in an IM for this process, you would probably honestly say at the outset, you're going to have a commitment from day one of $500,000, million, whatever that figure is, because yes, it may dissuade a buyer, but remember, you're also trying to get this process to move really quickly. When you're selling a business ordinarily, you'll go through a journey of discovery. You'll take weeks or many months, in fact, to go through that detail. You almost need to have your cards on the table, and that's the good as well as the bad. And you're probably more open-handed about the bad in this process, simply because you actually don't want to get into drawn-out conversations, and neither does your IP, with someone who 3 weeks down the line goes, oh, actually, you didn't tell me that. So that's probably your answer.
Presumably, Tom, there's a template to follow, presumably, is there?
Well, each firm will have their own template. It is about providing accurate, factual information. As Dan said, we're not selling a company over a period of 6 months in a normal M&A way. We are selling assets. There is no point hiding the bad news, because if it'll come out in 2 weeks' time when you're about to sign the contract and scupper the whole process. So they're generally, these IMs are generally to the point. They set out the assets, they set out the risk to the purchaser, they encourage the purchaser to take advice so that the process can be moved forward. And we as the IP would make sure what was presented, you know, was accurate as best we could. And if we would require information from the directors in order to, which we think was needed, and we'd expect that to be delivered up, about areas where we think buyers would have an interest.
Okay, brilliant. Thanks for that. I'm going to take the next question, if that's all right, but you two are more than welcome to jump in if you wish to. So it's about the CAA's attitude towards the financial requirements of the successor. So would they require trust accounts, guarantees, etc.? So I guess this doesn't just go for the successes. I think this is the way that CAA are moving going forward. Anyway, we're coming up to the March renewal for ATOLs. This is going to be the first renewal where everyone's financial year end is going to have been impacted by COVID. We've certainly seen them push more towards trust accounts going forward. So I think that is definitely on the table, but I think it's worth highlighting the fact that trust accounts won't work for every business, and so there will be alternatives around as well. But I think the way that the bonding market is and everything at the moment is that we're looking probably more towards some level of guarantees, whether that's personal guarantees or some other level of guarantee that can be given to the insurer or someone around on that side. So yeah, it's a different time at the moment where, you know, unsecured risks are very rare at the moment. So I think this is more for you, Tom. Someone's raised the question around up until January 2020, their business was profitable. Every month since then, it's been a loss-making business. On the, you know, despite them making lots of cost cutting and people agreeing to take staff pay cuts, etc. At what stage does the company become insolvent? So I know it's not just purely around whether they're making a profit or not. It's going to be how much, I guess, was in the business to start with. But are you able to give us a bit more
Sure. Yeah, so it's what will constitute trading insolvently. Well, I suppose the first thing to say is the wrongful trading provisions have been suspended, so there is no action which will be brought by an insolvency practitioner. To go back to the principle, I suppose, trading insolvently or wrongful trading is when a business trades when it cannot avoid insolvent liquidation. So as we stand today, there is no prospect of it returning to profitability and paying its liabilities. Then to carry on trading beyond today would be trading wrongfully, and the remedy for that is that the directors can be held personally liable for the losses to creditors incurred from today onwards. The reason that the wrongful trading was suspended is so directors wouldn't face that scenario. So it really is about looking at your financial position regularly and making a decision about whether there is a reasonable prospect of it getting better and returning to solvency. If there is a reasonable prospect, and that can be evidenced by financial information and a report or advice, then it's open to you to carry on trading to that objective. If there is no reasonable prospect, then to trade on would be wrongful trading.
Right, and when you talk about trading, that is the point of, yeah, whether you're selling more holidays or not.
Effective for the travel business, it would be, yeah, trading is the, you know, taking customers' money, booking holidays, employing staff. So to cease to trading would be to shut it down and go into the insolvency process effectively.
And that would be around selling new holidays, but presumably taking balances for existing holidays as well.
Yes, you'd need to look at the financial position of the company as a whole. As Dan said at the very start of this, you look at the position is that if you have loan notes or refunds due of millions of pounds and you haven't made any money for a year and you haven't got any bookings in the summer coming up because you specialise in holidays to somewhere, which is Brazil or something at the moment, is it reasonable to think that you will ever return to a solvent position in any reasonable time frame? That would be the question I'd be asking. If you're in a position where you have a limited number of refunds, you had resources previously, but you're starting to take bookings now and your summer looks better than you expected, it may well be reasonable to carry on because you can see that the company will turn around and those debts will eventually be paid.
Okay, brilliant, thanks. And I know you mentioned in your presentation earlier, you were talking about HMRC being a preferred creditor now. Do you see that as a huge game changer on that side of things?
I think the impact on that, if you take previously, employees were the only preferred creditor, and the next person down the line would be the secured lenders. So typically that would be your bank, who have a fixed and floating charge over your assets. So HMRC are effectively, in a lot of cases, jumping in ahead of the bank. Of course, that would then cause the bank to question a lending decision in the future, that if they were to lend money to this company, and they would typically take security against that lending, but if the company had a £100,000, £200,000 VAT bill, HMRC would take that money ahead of them. Would that security would not be worth as much, and that would presumably affect your decision on the lending. So I see going forward there will be an impact when companies go out to get debt as to the security the company can give and the value of that security, and ultimately potentially whether these organisations, banks or others, seek to ask the director to personally guarantee some of that potentially. Of course, it's open to the director to refuse, but I think that's one scenario. We've already seen in our firm, on an unconnected matter to anything Dan was involved in, HMRC having a preferential claim, which has effectively removed any opportunity of the bank recovering money under their charge, and HMRC will be receiving that instead.
Yeah, so I mean, yeah, I've personally seen a rise in personal guarantees anyway, so this could raise it even further, I guess. So.
It's worth adding that. It's worth adding that, of course, many of us have, well, I haven't actually, but have got deferred HMRC bills at the moment sat there, and clearly that potentially would impact any liquidation or administration process that anyone listening might enter into, and will adversely affect any payment that goes to the CAA or any other bond provider. So again, it has an impact in that market, and the same question comes back to the cost of bonding in the future, because they similarly, as Matt says, they've seen an increase in personal guarantees. Their level of base exposure is increased by the fact the government will take all the HMRC costs first.
Yeah. Apologies, we're going to go back to the previous question slightly, which was about the about when you become insolvent. One of the points you made, Tom, that someone's followed up on is about whether the company will be profitable in the future. Someone's raised the point that's a subjective view, I guess, that you could argue and say, well, you believed it would do, and actually it wasn't. How do you tackle that?
Yeah, well, this comes down to the incredibly difficult decision that people make, and it is for the insolvency practitioner and ultimately the court to determine if there has been wrongful trading. They will apply a reasonableness test effectively, and they will look back at what the director knew at the time. And if you recall from my presentation, I noted that boards and directors should keep board minutes and a record of their decisions. So they will look back at what you knew at the time and what information you had, and look at your decision and judge it to be reasonable or not effectively. So would a reasonable director faced with the same set of circumstances make the decision to carry on or not? So it is subjective, and it is viewed after the event, and you are dealing with the unknown. I think sometimes it's quite obvious when a company shouldn't carry on, but ultimately you seek advice, and whether or not you follow that advice is up to you, but you could take advice from an insolvency practitioner or a lawyer on that position, and that advice could give you some comfort potentially. But you're right, it is subjective.
Yeah, okay.
But each circumstance will be different.
Okay, excellent. Thanks for that, Tom. I know we've been running over a bit of time, so I am going to ask just one more question, if that's okay. And I'm afraid it is to you again, Tom. Around the sales process, really, is about how extensive that needs to be. I assume again there is some guidance around that, but you can't just stick it in in a local newspaper, I should imagine. It has to go further than that. So are there some rules that you can share with us around that?
Yes, SIP 16, which I mentioned earlier, sets out quite helpfully, the 6 marketing essentials, which set out the marketing process you should undertake. You should broadcast as widely as possible, rather than narrowcast is the wording, I think, in the SIP. You shouldn't rely on work. The director can't come to you and say, I've already spoken to that chap, he's not interested. You should make your own inquiries as the insolvency practitioner if you think they're a likely bidder. But ultimately, you need to comply with these requirements or explain why you haven't. In some instances, it will be appropriate to put an advert, in the FT advertising for sale. In some instances, that will destroy any value because all the customers will immediately see it's about to go into administration and force your issue. So it's open to you to justify why you haven't marketed as widely as people may consider you should have done. Generally, it's a balance. You balance cost, you balance time, you balance the likelihood of reaching someone who'll be interested in making an offer. So it is a judgment call by the insolvency practitioner, really. But you need to justify what you do to creditors, and you're held accountable for that. And ultimately, if you're dealing with a secured creditor, for example, you need to tell them what you've done and what offer you would look to accept, and ask them to release their security on their charge. And they like to do that if you haven't made any efforts at all to market it, I suppose. So.
Yeah, I guess some of the bits in there are a bit subjective as well, right? In terms of, as wide as possible, but I guess one person's view is someone else's.
Yes, and I think what you don't want to do is damage the brand by putting the advert for sale on the company's website. But can you approach sufficient numbers of people to, if you approach 20 people in the industry and ask them all if they wanted to buy the assets, and each one of them said no, there's no way I would buy that. Is that sufficient to test the market for the competitors, for example? That's something we might think about. If you approach one, that probably isn't a big enough sample. If you advertise on these sites where businesses of this nature are specifically advertised, the buyers are sophisticated. They know what they're interested in knowing. They can take a view, and you get a feel for the interest. What you hope for as an IP is you get 3, 4, 5, 6 interested parties, all pushing forward for more information, and that goes to price, and we achieve a better value.
Brilliant. Okay.
Just one point to add to that, Matt. I know it's an understandable concern because most of us don't know what the process involves. The initial marketing that's put out there is totally vanilla. It really is quite ambiguous to draw people in, and part of the IP's job is to filter those inquiries to ensure that they are potentially serious and genuine before there is any disclosure and potentially an NDA signed. So you don't get a situation, in my case, that you have ski weekends or Harry's holidays plastered all over the trade press going business for sale because it's in distress. So it's not quite as exposed as it feels. I have to say that there is a difference in approach between different insolvency practitioners and the firms and wider firms they operate for. They all have the same legal responsibility, but it was part of my decision-making process about how reasonable I thought some was going to be in frankly not exposing our brand to a market and creating a fire sale, creating a panic situation. Obviously, the IP has a responsibility to protect the brand as well, but you need to be comfortable with the way they're going to approach that.
Yes, it's getting that balance right. Yeah, brilliant. Okay, well, thanks a lot, guys. Thanks for your time today, and thanks for everyone for participating in the polls and listening to us today and the questions we've had. For me, it's been really interesting because I don't think this is, even though we're nearly a year into lockdown, since the first lockdown, I don't think it's a subject that's really been covered off in detail. So thanks for that, and thanks to everyone, and catch up with you all soon. Thanks.
Thank you all. Have a good afternoon.
Cheers. Bye.
Yeah.